Anyway. Hello, everyone, and welcome back to the Peterson Institute for International Economics. It is our privilege today to host a set of remarks by the Vice Chair of the Board of Governors of the Federal Reserve System, Philip Jefferson. We have been fortunate through the years to host a number of Philip's predecessors as Vice Chair, and of course, some chairs and some other members of the board. A few years ago, Philip's predecessor, Richard Clarida, came here and laid some of the groundwork for what later became the framework review that has since affected and influenced discussion of policy. Today, Vice Chair Jefferson is going to be focusing on the macroeconomic outlook, the current difficult to interpret set of ups, downs, rights, lefts, and there's probably some other spatial dimension I'm forgetting about. It's times like this for central bankers that I want to remind people of something Mervyn King pointed out long ago, before he was governor of the Bank of England, which I think is wise, which is if you're in the wrong place on monetary policy, it's actually not that intellectually hard to figure out what you need to do. You know you've got to go in one direction. And though, of course, the vice chair would not say that, I would say that was represented by the last couple of years at the Fed, and it went. When you're in the right place, it should be a close vote. It should be harder to discern what's the next move because you're not obviously off from your target. And in fact, of course, we are looking at a Federal Reserve leadership that has overseen and arguably brought perhaps the softest landing in modern monetary history. Again, I don't expect the vice chair to say that, he's too wise, but it's a wonderful time to have Philip here at the Peterson Institute. Just to recap, Philip Jefferson took office as the vice chair of the Board of Governors of the Federal Reserve System September 13th of last year. He has a 4-year term, renewable, of course. He's been a member of the Board of Governors since taking office on May 23rd, 2022, and if he feels like it, he can serve until January 2036 as a member. We'll see. Prior to joining the Federal Reserve Board, Professor Jefferson was a distinguished academic as vice president for academic affairs and dean of the faculty, as well as Paul B. Friedland, professor of economics at Davidson College. Before that, he served as chair of the Department of Economics at Swarthmore College, where he was the Centennial Professor of Economics. And he started his career, we were just talking about this, spending a year at the board as an economist at the Board of Governors of the Federal Reserve System. I'm not going to go through his CV. I will merely say we are delighted to have Vice Chair Jefferson with us today to explain his thinking on sorting through what's next when you're pretty close to good spot. Thanks very much.
Thank you, Adam, and thank you to Peterson for the opportunity to speak today. Before I begin, let me remind you that the views that I will express today are my own and are not necessarily those of my colleagues in the Federal Reserve System. I will take this opportunity to share with you my outlook on the U.S. economy and some upside and downside risk to which I am paying special attention. Also, I will review past monetary policy cycles and discuss what lessons we may learn from them. With that, let me turn to my outlook for the U.S. economy. Real GDP growth in 2023 came in much higher than expected by most professional forecasters, buoyed by strength in consumer spending. Towards the end of 2023, however, household balance sheets began to weaken, as indicated by higher delinquency rates and a further decline in savings. These developments lead me to expect slower growth in spending in 2024. Even so, without a clear understanding of why consumer spending has been so resilient, I see continuing strength in spending as an important upside risk to my forecast. One possible explanation is that consumers do not want to give up previous levels of consumption, perhaps because of habit formation, as described by Robert Pollock, and an optimistic view of future income prospects. Another possibility is the one raised by pioneering work by James Dusenberry 75 years ago and later developed in the context of modern macroeconomics by Jordy Galley. Socially motivated consumption, or keeping up with the Joneses, could cause individuals to consume more than what is predicted by models that only consider household wealth and income. The imbalance between labor demand and labor supply has narrowed, and labor demand has cooled while labor supply has improved. There is evidence of cooling labor demand, such as the decline in job openings by 3 million from their peak in March of 2022. Nevertheless, the labor market remains tight and job openings remain about 20% above their pre-pandemic level, as shown in Figure 1. At the same time, layoffs have remained very low, and the pace of payroll employment gains remains strong, with non-farm payroll monthly job gains in the past 3 months averaging 289,000. The unemployment rate in January was 3.7%, a level that is still near historic lows. The fact that the unemployment rate and layoffs have remained low in the U.S. economy over the past year amid disinflation suggests that there is a path to restoring price stability without the kind of substantial increases in employment that have often accompanied significant tightening cycles. Inflation made clear progress over 2023 towards the Federal Open Market Committee's 2% inflation objective. I believe that this progress reflects both the unwinding of pandemic-related supply and demand distortions in the economy, as well as restrictive monetary policy, which has cooled strong demand and given the supply side of the economy time to catch up. As shown in Figure 2, over the 12 months ending in January, the Federal Reserve staff's estimates that total personal consumption expenditure prices rose 2.4%, down from 5.5% over the preceding 12 months. Core PCE prices, which exclude energy and food prices, rose 2.8%, down from 4.9%. The figures for January are estimates that incorporate the somewhat larger consumer price index increase that we saw last month. That disappointing CPI reading highlights that the disinflation process is likely to be bumpy. The January data notwithstanding, the slowing in core inflation has been especially pronounced in recent months, as the 3 and 6 month changes in core PCE prices through January at 2.5% and 2.4% respectively clearly remain below the 12-month change shown in Figure 2. The most striking moderation has been in core goods prices, as shown in Figure 3, which have declined outright over the past year. Inflation in core services, both in its housing component and non-housing services, has also slowed, but not as much. I believe that as the labor market continues to cool, core service price increases will continue to moderate. Of course, I remain attentive to other possibilities. Next, I would like to highlight key aspects of past monetary policy cycles and what lessons we may learn from these past experiences. For exposition purposes, my review focuses on easing cycles and their preceding peak rate episodes that extend back to 1989. However, I will also make some comments on an important episode prior to 1989. As of our last meeting in January, my colleagues on the FOMC and I believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. I will therefore start with a description of economic conditions during past peak rate cycles, given where we are today. The first column of Table 1 lists the dates of the last 6 peak rate episodes preceding easing cycles, defined as a sequence of rate cuts without rate hikes in between. The second and third columns summarize economic conditions as described in official accounts of monetary policy released at the time, such as FOMC statements, minutes of the committee meetings, and the Federal Reserve Board's semi-annual monetary policy report. The table also records inflation at the time of the peak rate as measured by the 12-month percentage change in headline and core PCE price indices. My main inference is that most of the time, in 5 out of the 6 episodes, the peak rate is reached once inflation is contained, albeit in some cases with risks still present. There is only one exception in this sample. The March 1989 to May 1989 peak rate episode, when inflation was elevated, noted in the first row of the table. The easing cycle following this particular peak rate episode began as core and headline PCE inflation were starting to come down from an elevated level, as shown in Figure 4. This figure shows headline and core inflation 2 years before and after the start of each of the 6 easing cycles. The red line, which corresponds to the March 1989 peak rate episodes, stands out, with core PCE inflation at 4% at the beginning of the easing cycle, while all of the other easing cycles show core PCE inflation at about 2% at commencement. Our situation today is closer to the norm during these episodes than to the exception, as PCE inflation is closer to 2% than to 4%. Table 2 summarizes the reasons given in Federal Reserve documents at the time to explain the rationale for easing policy. When studying monetary policy cycles, it is important to recognize the often multi-stage nature of cycles. And because of this, Table 2 distinguishes between the reasons underpinning the start of the easing cycle, listing it in column 2, and those underpinning subsequent easings listed in column 3. One clear example of a cycle with different phases and involving more than one reason for easing is the most recent easing cycle, the one listed in the last row, which took place between August 2019 and March 2020. The initial 75 basis points of easing in this cycle were a result of downside risk to the U.S. economy due to weaker global growth and high trade uncertainties. The subsequent easings in this cycle were due to disruptions in the economy resulting from the COVID-19 pandemic. Looking at Table 2, two facts stand out. First, most easing cycles start because of concern about slowing economic growth. In Table 2, the one exception is the easing cycle that was started in July of 1995 and is associated with what Alan Blinder has labeled the perfect soft landing example. That particular easing cycle started predominantly because of reduced inflation concerns. All the other easing cycles started because either there was a concern about slowing economic growth, or in one case, because there was a concern about slowing economic growth and there were reduced inflation concerns. The second fact that stands out is that history is replete with events that complicate monetary policy decisions. The third column in Table 2, which notes the reasons for subsequent easings, demonstrates this point. It shows that 4 out of the 6 easing cycles had multiple easing phases, with later phases triggered by events like the 1991 Gulf War, the 9/11 terrorist attacks, the global financial crisis, and the pandemic. These events require policymakers to take a different course of action, a different course of policy easing from the course they may have anticipated earlier in the cycle. Specifically, because these events contributed to the contraction of economic activity, policymakers may have accelerated policy easing. The main message that I see emerging from this review of this record are that policymakers need to remain vigilant and nimble in case of adverse shocks hitting the economy, and that policymakers need some good luck. The lesson that policymakers need to remain vigilant and nimble is further illustrated by Figure 5, which shows the unemployment rate around the start of each easing cycle. As can be seen from this chart, in some easing cycles, for example, the easing cycles that began in January 2001, shown in blue, and September 2007, shown in green, the unemployment rate ramps up quickly shortly after the easing cycle began. In both of these cases, the economy weakened rapidly. In the easing cycle that began in January 2001, moderating growth over the second half of 2020 moderating growth in the second half of the year 2000 gave away abruptly to sluggish growth around the end of the year. Economic weakness spread and intensified over the first half of 2001. And as shown by the blue line, a year after the easing cycle began, the unemployment rate had increased just short of 2 percentage points. In the easing cycle that began in September 2007, the macroeconomic data were not showing much weakening at the time of the cycle's first couple of rate cuts, although financial markets were exhibiting heightened and broad-based volatility, and short-term funding markets were significantly impaired. It was only in December of 2007 that incoming data started to show more significant spillovers of the housing downturn to other parts of the economy, while several financial firms also began to report larger than expected losses. As the green line in the chart shows, the unemployment rate was about 4.5% at the start of the 2007-2008 easing cycle, having remained broadly stable around that level in 2006, but then rapidly rose to 6% within a year of the first easing. My motivation for discussing these two episodes is to highlight how quickly the economy can weaken. Another reason why policymakers need to watch all available information and be nimble in their decision-making is that developments concerning inflation can likewise change rapidly. This was illustrated recently by Russia's invasion of Ukraine in March of 2022. The invasion compounded the effects of post-pandemic supply constraints on inflation. In addition, we always need to keep in mind the dangers of easing too much in response to improvements in the inflation picture. Excessive easing can lead to a stalling or reversal in progress in restoring price stability. Former Fed Chair Paul Volcker stressed this danger in a 1981 speech when he pointed to 1967 as a year when monetary policy eased in response to concerns about slowing economic growth and reduced inflation concerns, yet inflation subsequently turned back up. Finally, another observation from reviewing past episodes is that careful easing in the July 1995 easing cycle allowed the FOMC to assess incoming data and other information to make sure that inflation was under control. As I noted earlier, the July 1995 easing cycle is associated with the so-called perfect soft landing. In this particular easing cycle, the FOMC started to ease as it observed a lessening in inflation concerns, left rates unchanged for 3 meetings as it waited for more information, and then continued to ease. With the knowledge of past experiences in hand, let me say a few words about the current monetary policy cycle and the extent to which future policy is likely to resemble, if at all, past experiences. Between March of 2022 and July of 2023, the FOMC raised target range for the federal funds rate 5.25 percentage points. Our strong actions have moved our policy rate well into restrictive territory, and our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back our policy restraint later this year. Getting back to the title of my talk, will this time be different? My answer is, of course it will. Every time is different. But we can still learn from past episodes. We cannot know if there will be unanticipated exogenous shocks that require a policy response different from what will be envisioned at the beginning of the easing cycle. All we can do is assess the risk as best we can, given the available information and our best forecast. In the absence of unanticipated exogenous shocks, policymakers can weigh multiple factors, including keeping policy restrictive enough to tamp down on a possible resurgence of inflation due to strength in aggregate demand, or easing sooner to avoid an undue increase in unemployment. Unfortunately, the history that I have reviewed today suggests that we should not be surprised if some type of unanticipated shock occurs. Given that we must accept that uncertainty is present, we consider the risk that can affect our outlook to our forecast. Looking ahead, I see at least three key risks. First, as I mentioned at the beginning, consumer spending could be even more resilient than I currently expect it to be, which could cause progress on inflation to stall. Second, employment could weaken as the factors supporting economic growth fade. Third, geopolitical risk could remain elevated, and a widening of the conflict in the Middle East could have greater effects on commodity prices such as oil and on global financial markets. I remain cautiously optimistic about our progress on inflation, and I will be reviewing the totality of incoming data in assessing the economic outlook and the risks surrounding the outlook, and in judging the appropriate course of future monetary policy. Thank you. Okay.
Great. Thank you so much, Vice Chair Jefferson. It's great to have you put in the broader historical context this kind of monetary policy cycle. I'm going to ask you a few questions based on your remarks. This is all on the record. It's being streamed live, obviously. And then we'll turn for questions, not statements, questions from members of our in-person audience. So, I mean, as you made clear, there's two pieces to your remarks, which is the assessment of the current situation and the path of past peak rate hikes that follows. And obviously, you tried to pull lessons together for these. Can I ask you a couple things first about the current outlook sort of more narrowly? So one thing you did not emphasize in your three risks, at least three key risks, at least specifically, was the idea that the real interest rate is going up, or as measured by the Fed funds rate, say, as the inflation rate goes down. I'm not saying you necessarily should, but what's your thinking on how big an effect that is or how relevant that is?
Well, thank you for your question. What's relevant in terms of my thinking about your question is whether or not policy is currently having putting downward pressure on economic activity. What you're pointing out is the possibility that even when the policy rate stays constant, the real rate is becoming more restrictive. And my focus in thinking about that type of issue is it the case that policy is in a position where it's helping to bring aggregate demand and aggregate supply into better balance? And so that's my focus as I think about the current setting of the interest rate in a declining inflationary environment.
Great. You also mentioned in some detail various mechanisms through which consumption decisions by households might go to the upside or the downside from here. Again, I don't think you mentioned this directly. One thing which I and some other observers have focused on is the state of household balance sheets, that as opposed to the flow of income, they actually are historically quite strong. Again, do you see that as a factor worth watching, or is that something you take for granted, or does it not have much leading power? How do you think about that?
Well, certainly coming out of the pandemic, the state of households' balance sheets was an important factor for explaining the strength of consumption. It was something that across the income distribution, households, because we couldn't consume during the pandemic because of the various lockdowns, really built up very strong balance sheets. And as we emerged from the pandemic and the economy started to open up, there was considerable strength coming from the household sector because of the strong balance sheets. Over time, what we've seen is that those balance sheets have weakened, particularly so in the lower parts of the income distribution. And so my view is that over time, the balance sheets will normalize and become less of a factor in stimulating consumption. However, it still seems as though in some parts of the income distribution that strength is there. So that may be one of the reasons why consumption has been so strong.
Final thing on the current situation before going back to some of your broader lessons. Your colleague on the Federal Reserve Board of Governors, Christopher Waller, came out with, turned out to be a prescient argument for the idea that vacancies could drop without unemployment rising very much as part of the disinflation process. Some of my colleagues at Peterson had taken the opposite view, and fortunately for the economy, that happened to work out. Just as a sitting policymaker, without commenting on Chris or our colleagues, but the issue, how surprised were you by this development? What lessons or broader implications do you think there are, if any, to the fact that vacancies went down so rapidly without a rise in unemployment?
Well, my view on that is that the pandemic was a very unusual event, okay? And that whenever you have an unusual event, there's the possibility that past relationships in the economy will no longer hold. That is, there can be structural changes or changes in the way certain markets operate. So I can say that the labor market now seems to be normalizing and rebalancing in a way that is supporting disinflation without causing unemployment. As I noted in my remarks, we still have a high number of vacancies available, and it has been very helpful, I think, to the American economy and the American people that we haven't seen the kinds of layoffs that we have seen in the past and actually appeared in one of the graphs that I showed you, which shows the capacity of the labor market to support disinflation without causing as much pain that some may have anticipated when the policy rate started to become more restrictive.
Thank you. Again, going back to the broader themes in your speech, and I'm sure it's going to be very widely cited, the table abstracting the discussion points in the previous episodes you've mentioned. You make reference to Alan Blinder's interpretation of 1995 as the sort of soft landing paradigm. paradigmatic case. One of the aspects at that time, which we know from the minutes, was then Chair Greenspan's perception that productivity growth trend had shot up. And at that time, then Vice Chair Blinder and now Treasury Secretary Yellen, who were on the committee, were skeptical. They were on record as saying we're pushing the NARU too low. We're pushing too low on the NARU. Anyway, how do you see the last 3 quarters of productivity growth or the prospect of generative AI feeding into your discussions about the current soft landing, about what are the prospects for the next couple of years?
Well, we have benefited from rapid increases in productivity lately. And so what that suggests is that the supply side is healing. The supply chains disruptions that from the pandemic are getting better. And the economy is benefiting from that. So one way of thinking about that is that perhaps potential GDP growth has expanded. And so I think it's too early for me to conclude that it's all as a result of AI,
Right.
Because that has to do with how much penetration there has been across the different sectors of the economy. But whatever the source of the productivity increase, it is beneficial to the disinflationary process. I think that the expansion in productivity growth has helped the economy to continue to grow while policy has been restrictive, and thereby bringing the inflation rate down. So again, it's this balance between aggregate supply and aggregate demand, where I'm grateful for all of the help from the supply side
Right.
that we can get, because at the end of the day, we want to continue to have growth, maximum employment, and bring inflation down towards the committee's 2% target.
Great. A final question for me, and then we're going to turn to our live audience. There will be 2 roving mics when we come to you. Please state your name and your affiliation and state a relatively brief question for the vice chair. So the last thing coming from me is sort of relates to that point. So you list these occasions when there was a sharp rise in unemployment or a decline in growth following the Fed already having peaked. Is that something you see as essentially inevitable because of lags built into the economy and uncertainties? Is that something where you see the Fed maybe could avoid a mistake in some sense? And if it was a mistake, what's the nature of the mistake that you think the Fed made? It's fine for you to say you don't think the Fed made a mistake, but to the degree some of those in hindsight seem avoidable, what would you have done differently?
Well, I think the tables that I pointed out indicated that other things happened,
Right.
that caused the economy to weaken. And the takeaway that I have is that the labor market is one of the markets where things can change quickly in ways that we don't anticipate. And so that's the value in us proceeding carefully as we think about the stance of monetary policy. At each and every meeting, what we're trying to do is look at the available data. We are trying to assess the risk, and we're using our best forecasts. And we're trying to do that in real time. And so policy always has to be vigilant and nimble, as I've mentioned. So when I look at those past cases that you talk about, I really try to put myself in the place of those policymakers and looking thinking about what they must have been facing. And what we learned is that the labor market can change dramatically. We have to be careful, and we have to try to assess the different shocks that can hit the economy and adjust policy accordingly.
Perfect. Okay, to our audience, if someone would like to raise a question, the gentleman there. Yeah.
I'm Stan Voiger, the American Enterprise Institute. One gets the impression, also from the history that you discussed, that the Fed is reluctant to tighten, then ease, then tighten, then ease again too frequently over short periods of time. But at least in some models, I think that's what the optimal policy path looks like, especially when you're not relying super heavily on forward guidance. And so my question is that impression correct? Can you talk a bit about the motivation for having these relatively smooth cycles of easing and tightening?
Well, let me make sure I understand the question first before I try to respond. Is your question that historically, from your perspective, is the case that the Fed doesn't like to ease and then tighten, ease and then tighten, ease and tighten? I want to try to respond to that from my perspective as a policymaker, okay, in that I think it's the case that the Fed is not trying to be consistent in its policy and its outlook of the economy and being responsive to what we actually see as happening. And that if it's the case that we are being deliberative and forward-looking in our policy and recognizing that there are lags in the effects of policy, then we want to move in a way that is mindful that what we do today will take time to work its way through the economy. So with that understanding of the lags effects of monetary policy in mind, you would want to proceed in a way that would not cause you to increase one meeting, decrease in a few meetings later, then increase, because that could actually create policy uncertainty that would make economic decision-making even more difficult for households and businesses. So we try through our communications to be as transparent as possible so that market participants, American households and families can have some reasonable expectation about future steps in policy.
Thank you. Right at the back, the person next to the camera person, and then the lady here at this table.
Hi, Nick Timmeros of the Wall Street Journal. Dr. Jefferson, I guess my question is, do you need to see evidence of economic weakness or growth scare before you cut? You cited 1995 as an example where maybe that wasn't the case, but there had been a negative payroll report before that cut. There had been a global bond market rout. The Mexico peso crisis was a not distant memory at that point. So you could argue that even in 95, there were growth concerns that animated the committee's thinking. So my question is, do you need to see signs that the economy is actually slowing before you would lower interest rates? Thank you.
Thank you. Well, we have a dual mandate, which pertains to employment, maximum employment, and price stability. And at each moment, I think we are trying to fulfill that mandate, and we get to some point in the cycle where there's a balance of risks on both sides. And your question about do we actually need to see evidence of a growth scare, is one in which, when I think about policy, I'm looking at the totality of the data in the economy. So I'm going to be looking at labor markets growth, productivity on the real side, and then inflation and on the price side. So I don't think it's necessarily one thing that we would have to see before we think about cutting. I think we want to see evidence that inflation is sustainably at our target level or going towards our target level. And we want the economy to remain strong as possible. So in answering to your question, I want to say that it's not one thing that would trigger it. I'm speaking for myself. Let me also say all of the responses I'm giving today are just, I can't speak for the committee, okay? I'm speaking for myself. So I'm not just looking at one indicator to determine whether or not whether or not that's the time to start. I think there would have to be a body of evidence about macroeconomic performance that would then weigh in the direction of, okay, now is the time.
Great. And our last question, please.
Carol Wayman, Senator Catherine Cortez Masto, speaking for myself. A question on the labor market. How are you thinking about the growth in part-time jobs with unstable work schedules when you're looking at employment factors?
Well, in the conduct of monetary policy, I tend to focus on the aggregate numbers. And while I am very aware that behind those aggregate numbers are very different outcomes for types of jobs, demographic groups, geographical regions, all of which are important things to think about, because I don't discount that at all. But our mandate from Congress is more of an aggregate, is with respect to the aggregate performance of the labor market. And so while we get information on all different aspects, as a policymaker, I am thinking about what's happening at the highest aggregation as I'm thinking about the labor market. So with that in mind, as I'm making policy, I tend to focus on the part of our mandate. When you mentioned the labor market, it would be things like the aggregate unemployment rate, the number of jobs being created overall. That would be of central importance to determining what policy that I would advocate for going forward.
Thank you. And so with that, we're at the end of our time. Please join me in thanking Dr. Philip Jefferson, Vice Chair of the Board of Governors of the Federal Reserve, for sharing with us his retrospective view on recent monetary cycles and his prospective view on policy in today's economy.
Thank you.